Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. On this episode of Wealthy Behavior, we have Sam Rowe, founder and editor at Tker, one of my absolute favorite investing newsletters and someone a lot of people in our industry follow. If his name rings a bell, it's also because he's the first two-time guest on Wealthy Behavior, having joined us last October to discuss stock market truths and why it makes sense to be a long-term optimist. I'd encourage you all to check out that episode and also his Substack, where he shares multiple investing articles a week with readers. Welcome back to Wealthy Behavior, Sam.
Thanks for having me.
Absolutely. So it's been 10 months since we talked, and markets have done well since then, which I would imagine doesn't surprise you too much.
Yeah, it was funny. I think when we spoke 10 months ago, we were still talking about big economic tailwinds, stuff like a lot of extra job openings in the labor market, a lot of demand for labor, healthy consumer finances. Things like orders for capital goods. A lot of leading indicators were, flashing green, telling us that the economy was, still had a nice tailwind to its back, and that the economic data would be good for the months to come, which is great news for the sales of companies that we all invest in, and that translates into great earnings. And if earnings are great, the stock market is probably going to go up. So yeah, I think that's been the big story for a little while. But more recently, it seems like a lot of those metrics are starting to cool.
On the economy, yeah, and I want to get to that. You talk a lot about earnings, and that earnings really tell you the direction of where stocks will go. We just came off a pretty strong second quarter of earnings, which you've written about as being a positive signal going forward.
Yeah, I think it's a positive signal. I think it's hard to exactly calibrate what expectations were going into earnings season. There's always a lot of skepticism, especially when you see economic metrics like job creation and things like that start to cool. But the message coming out of earnings season has been that while the economy is cooling, the economy is still growing.
Okay.
Right. While spending might be slowing, it might not be as hot as it has been for the last 2 years. It's still growing. Now, there's areas of weakness, but there's always areas of weakness. Sure, low-income consumers are spending a little bit less, but they're always spending a little bit less. I'm not trying to sugarcoat any of that stuff, but that's just sort of the reality of how business works and how the economy works. And so coming out of it, what we've seen was companies that were either matching or meeting earnings expectations, whatever you want to make of that. But the important thing being that both companies reiterated a lot of their guidance for the rest of this year, and some even for the next year. And analysts looking at those numbers and deciding that, hey, it looks like companies will continue to deliver earnings growth. And what we have is expectations for double-digit earnings growth going into 2025.
A large part of that is driven by margins doing better. Is that right?
Yeah, that's a huge part of the story. If anything, that's probably the most important part of the story.
Okay.
If one of the other side of this trend, we were just talking about how consumer spending growth is slowing. And so a lot of companies were telling you that sales were slowing, but they're also recognizing, the fruits of a lot of changes they've made over the last 2 years. Whether it's putting workers into new roles, or upgrading equipment, or updating software, whether it's enhanced with AI or not, whatever you want to make of it, it looks like operating efficiencies and productivity is way up for a lot of these companies. And so one of the big trends of this most recent quarter was that low single digit sales growth was translating into high single digit or even double digit earnings growth, because a little bit of sales growth with a lot of fixed costs and operating efficiencies is translating to earnings growth. So this is important for investors to think about as they read more and more headlines about how the economy is slowing. Yes, that may be the case, But for companies who have revamped their operations, a little bit of sales growth is going a long way in terms of earnings, and that's good news for stock prices.
It's definitely good news now. Is it something to be concerned about maybe longer term, whether these margin improvements are sustainable or whether they can revert to the mean?
Yeah, absolutely. Of course, that's if there wasn't something to be worried about, stock prices would be, fully priced and there wouldn't be great returns. But yeah, absolutely. I think that's a big concern. I mean, one thing that could come with relatively high margins and a slowing economy is companies increasingly competing for price.
Okay.
That's something that we have heard from a lot of consumer discretionary companies saying that they're competing for price. Walmart's cutting prices on a lot of their goods. McDonald's has $5 meal. Other company like I think KFC just announced a $5 meal. It's great that well, great. It depends on the perspective, right? But companies were able to preserve profit margins and earnings when, consumers were feeling very flush. But, when you have job growth slowing, when you have unemployment slowly ticking higher, which is happening, when you see stuff like credit card delinquencies start to tick up and the consumer become a little bit more pressure and businesses become a little bit more pressured, in order to keep your own businesses competitive, yeah, you might start to compete for price at the price level so that you can steal your competitors' volume. So yeah, I think that is a concern, but who knows? We'll see down the road. Maybe the economy starts to pick up more momentum. Maybe we get some favorable policies that stimulate the economy. Who knows? But I think it is good news though that signs still continue to point to growth. While it's slowing growth, it still continues to point to growth.
Yeah, absolutely. And what have you made of the Fed? Did they cut to, are they going to cut? Is it going to be too late? Should they have done it already? The whole Fed watching narrative that is important, but does get a little tiresome.
Yeah, I think it's important. I think, I mean, the way I would frame it is I think that conversation is not quite as important as it used to be.
Okay.
Yeah, I mean, Fed policy absolutely matters and interest rates affect absolutely everything. But I think when we were talking about quarter point rate cuts or rate hikes or 50 basis point rate cuts or rate hikes, I think that stuff is much more important during times of economic crises or economic strain, right? When you're in the when you're in the middle of a financial crisis or when the pandemic is shutting down businesses, these moves really make a big difference. When you have 9%, CPI, monetary policy decisions can be major market moving events. But we have low inflation, we have low unemployment, the economy is generally pretty good. And so the conversation right now, I think, is much more focused toward people who are more interested in the fine tuning of monetary policy as we get back to whatever normalcy is. But we are not in anywhere close to any kind of a crisis. I think there is an argument to be made that we might have higher recession risks than we used to. I mean that's what happens when you don't have the massive economic tailwinds as we used to have. Your recession risk goes up. Doesn't mean that's guaranteed, but the risk is going up. And so, the conversation is shifting toward, what rate cuts look like. And from there, I would say that, this discussion about no rate cuts or 25 basis points or maybe even 50 basis points or a couple of rate cuts by the end of the year. I think it's important to recognize first that if we get one, two, or four rate cuts by the end of the year, the Fed funds rate and monetary policy in general is still tight relative to what we've seen in recent years. All that means is monetary policy becomes a little less tight. This is not loose monetary policy, but it's a little less tight. And maybe that's something that is just enough to reduce some of the concerns people have about, recession risks.
You take a lot of value, it seems like, out of following corporations, corporate earnings, listening to the calls, reading the transcript. What can an individual investor glean from that, even if they don't own a particular stock that they're following?
Yeah, I mean, I think there's two ways to think about messages coming from corporate America. And before anything, you just have to be really careful about what you hear and what signal that you extract from it, because it's very much possible that something that a corporate executive says may be reflective of bigger issues in the economy, or it may be reflective of something very idiosyncratic and specific to the company's ability to execute. I think what matters when you are listening to a corporate earnings call is to go in with a pretty robust macroeconomic framework, get a good sense of where things are when it comes to stuff like employment and consumer finances at the national level, at the aggregate level. What do we know about, household balance sheets, in aggregate in the entire country before we start to hear, from what these companies start to say. And, when the executives confirm, what you know about the greater economy, then then you have confirmation that the economic
Mhm.
data is right. If they're saying something that's in conflict, then maybe it's something that you just keep an eye on and listen to. Maybe it is company specific, or maybe it's a start of something worse. And then, if the economic data starts to turn, or if more and more companies start to speak this way, then maybe there's a signal to extract from that. But I would be really careful about, because something that does happen in the news a lot, and it's news, right? There's nothing necessarily inaccurate about any of this stuff, but it's very easy to get quotes from three or four different earnings call that really sounds like, it's sounding the alarm for the economy, when it might just be, three companies that happen to be really crappy at executing, or maybe it's a very particular niche that's struggling that we already know about. Like, listen, the economic data will also tell you that people, low income, low credit rating households are doing poorly. And if companies are saying that too, then they're confirming something that we already know. But that's just one part of a bigger story that is continuing to point toward growth.
Are there any companies that you consider bellwethers that you don't want to miss what they're saying, or any CEOs that you think are particularly candid with their messaging that you don't necessarily have to question whether, hey, is this really happening only to them, or is the world ending?
I do like to listen to Walmart.
Okay.
I've been listening to Walmart for maybe 17 years now. One thing that Walmart has going for them is they have a lot of customer data.
Okay.
They have a lot of customer data, and they really understand how supply chains work in the country, and they know how things move around, and they know every last detail with every last region of this country. It's almost chilling how much information they have access to. But I do like to listen to what they have to say, because it is often a pretty decent reflection. I mean, maybe it's different now with the emergence of online shopping and online grocery and all this stuff. But it used to be that Walmart represented a not insignificant share of the dollar spent by the U.S. consumer. So yeah, I'll listen to them, and they are also very mindful of exactly how they word their language, because they do know that not only will it move their own stock price, but it can move markets in general. Yeah, in their most recent quarter, the first time you read it, or hear it, it kind of sounds like gobbledygook. But their CFO was saying that the consumer hasn't gotten worse. Spending is still growing, but not at an accelerating rate. And they also said something along the lines of, "We wouldn't say that they're strong, but they certainly aren't weak." I
All
mean,
right.
that's almost like the most political way of answering a question, but I think it's actually in line with everything that we've been reading from an economic standpoint. Consumers aren't as flush as they used to be, but they are still financially healthy from a historical basis, and spending growth, continue to be positive. And of course, I think it was maybe a day or two after the Walmart earnings call that we got this better than expected retail sales report, which again is national aggregated data. I mean, those numbers are much bigger than Walmart sales, and they were both pointing in the same direction. So yeah, Walmart is usually a pretty good read on things. But yeah, you always want to be careful, because sometimes it's a reflection of higher income consumers trading down to more affordable things.
Sure.
But it's hard to tell. But the management does a good job of articulating that.
This could be an unfair question, but if you only had access to economic data or to corporate earnings reports, which one would you choose?
I think I would have to go with the economic data. I
Okay.
mean, because I think if I was more of a short-term trader, I would go with the corporate earnings reports because it's much more real time. But because I like to focus a little bit more long term, I think the aggregated data makes a lot more sense. Which is it's kind of an interesting thing to say because the economic data that we talk about also covers a lot of small businesses that aren't publicly traded companies in the stock
Right.
market, but all those businesses are very much customers of these big publicly traded companies. So I do think that the macroeconomic data matters. And can tell you much more in a much more clear way long term. The one thing that is not as great. I mean, they do have profit margin data, that the BEA releases every quarter, but something that you do get with much more granularity in the corporate earnings announcements is information about margins and how they're, making tweaks to operations to address things like, slowing sales growth. But yeah, if I had to pick between one or the other, I mean, that's a really tough choice.
So
But
I
yeah,
prefaced it
I would
that
go
way.
with
Yeah.
economic data.
Yeah. And you shared a great post with your readers, I think earlier this summer, on some of the free resources that you rely on and that you add a lot, take a lot of value from. What was that piece called, and where can people find it on your site?
Yeah, I forgot exactly what the number was, but it might have been like the 10 free newsletters that I read
Yeah.
every time. I've subscribed to probably 40 or 50 finance newsletters that I try to, keep current on, but there's a handful that I do read every single time that it hits my inbox. So I would recommend that. That newsletter is freely available. At Tker.co. It was published, I think, maybe 1 or 2 months ago.
Yeah.
But yeah, it's a lot of the free resources that I go to. It includes both newsletters as well as research sources. A lot of what I do is based off of information that's freely available. But the value I try to communicate or the value I try to extend to my subscribers is, I'll spend 25 hours reading through all this stuff and get you, the stuff that you need, in a newsletter that you can read in maybe 5 to 6 minutes.
Yeah. So pivoting a little bit to earlier this month, and I say this tongue in cheek, it looks like we all survived the market meltdown of early August. And I don't mean to be obnoxious about it because it was a pretty sharp 2 or 3 day move, which I think is more what surprised people, not the idea that markets go down 7 or 8%, which we tell clients all the time is par for the course. What were your takeaways from just that stretch with the markets and maybe some of the narratives that came out about it afterwards?
Yeah, it's moments like that can be really scary because you can never be 100% certain about anything, right? You can never be 100% certain that this is the next financial crisis, or you can never rule it out with 100% certainty. So yeah, the first thing you do is you try to read up on as much as possible as to what might be moving the needle here. And I just found it really unsatisfactory that people were suddenly getting gloomy on the economy when the data was mostly confirming, what we've been reading about for months. So yeah, maybe sentiment was shifting a little bit, but it wasn't so much so that I think that it warranted that much of a jarring change. Like, sure, maybe a handful of people wake up one day and suddenly realize that they want to get out of stocks, and yeah, that'll create some dislocations in the market because there aren't enough people selling to or people buying
Fine.
in the
Yeah.
normal, daily average trading volumes aren't used to handling that kind of flow. And then you start reading about stuff about the Japanese carry trade unwinding and stuff like this. And that's a risk that I feel like I've been reading about since I got into this business. Unless you find out that biggest financial institutions built their entire business model off of something like that, then maybe there's something to worry about. But yeah, I think in a nutshell, it's you do your best to try to figure out if something has actually changed, and if things haven't changed too much, then you wonder if it is just sort of regular run-of-the-mill market machinations, which, are often affected by things that sound very scary, like a
Mhm.
hedge fund blowing up or a bank failing or, some country defaulting on its debt or something along those lines. But I think at the end of the day, particularly in the stock market, and to be clear, like other areas of the financial markets, I can't really speak to too much. But particularly for the stock market, it is a question of, well, what does this mean for earnings? And when you think about earnings, it's stuff as simple as, is what happened this weekend going to stop people from shopping? Like, is this going to stop people from doing the back to school shopping at the end of the summer? Are people canceling birthday parties? And are you not going to buy new clothes, or are you not going to, go to that restaurant that you had a reservation for? No, because this was not affecting finances for most people. Like, I don't know anybody personally using their own money to be in the Japanese carry trade or whatever. I know that there are hedge funds and traders that get mixed up in this kind of thing, but there wasn't a whole lot telling me this was going to move the needle in terms of the fundamentals of both the economy, the U.S. economy at least, and earnings. And in the days that followed, in the earnings announcement that came out, companies were generally, not too concerned. Like, no one was changing their scripts because of what happened in the last couple of weeks. No one was suddenly coming out and saying, we're revising lower our Q3 earnings estimates because of what happened in early August. And so I guess it's not too surprising to see the market come back. Like, I don't know if it was predictable that the market would come back as quickly as it did, but when you look back, and you see that earnings revisions have held up, and the corporate commentary has been stable, it's not too surprising to see the market recovery the way it did.
Do you think it was some sort of flash crash type event, or is that overstating it?
Sure, I would say it's a flash crash type of event.
And sorry, do you mind explaining real quick what we consider flash crash type events?
Well, I think that's actually part of the issue, right? How, like, what is the time frame for a flash crash? I don't actually really know if there's a scientific definition. Like,
No,
there
there
there wasn't
definitely isn't.
I mean, there were a couple of instances, in recent history, and when I say recent history, in like maybe the last 10 or 15 years, where you'll see like 1,000 point drop in the Dow, or 1 or 2 percentage point drop in the Dow in seconds, and then within minutes it comes back. And so I guess that's sort of the classical flash crash. But I don't know. I would argue that seeing an 8% drop over a week or two, that is very jarring. I think a crash becomes a flash crash when the market comes back. So I think the fact that it only took a week or two to recover a week or two of losses would characterize that as a flash crash. So I would say that a flash crash, in my opinion, would be something where the market seems to be moving based off of things outside of fundamentals. If that's the definition we're running with, then yeah, I would say that what we've experienced was a flash crash.
Yeah, great. So, what are you curious about now? What are you going to dig into for readers over the next 2 to 3 months?
Yeah, I mean, I think it's a question of further deceleration, or if we get a reacceleration in the economy. I hate to characterize it as easy, but I feel like the last 2.5 or 3 years wasn't super challenging because there was so many tailwinds when it came to the economy. Like the whole narrative about consumers having, trillions of dollars in excess savings. This was a no-brainer that yes, spending will be high because of all this money people have. Now that that has kind of evaporated and consumer finances are, I mean, they're still strong historically, but that they're starting to normalize, means that it's less clear what economic growth looks like going forward. And it's the same thing with job creation too. For the last 2 years, there were close to two job openings for every unemployed person. Now that's gravitating back toward almost 1 to 1, and it's, back to levels that we were at, before the pandemic. Does that mean the job market looks terrible? No. but it's just becoming less obvious that growth is destiny for the economy. So I'm interested to see, what the new narratives are that emerge, that kind of define, the coming quarters and the coming months. Maybe it has something to do with shifts in monetary policy. Maybe some exogenous event happens, out there. I think it's really strange when you start to see investor surveys come out because like the Bank of America Fund Manager survey and some of these other things where the surveyor asks questions, what are you concerned about? What are the big risks? And for the last couple of years, it's been this rotation of it's either inflation or it's geopolitics or COVID, the virus, all these things that are really scary. But once you have a lot of these, big headline risk stories start to recede, then the big risk that everyone's talking about is, well, are we going to go into a recession? That's pretty plain Jane generic in my opinion. And that also means that, we're running out of things to be scared of and running out of things to be nervous about. I've written about this too. Like when the markets are doing well, that's a really great time to just sort of slap yourself in the face and say, hey, things can go wrong real quick. And, we just have to know that when that time comes, that we have a plan, that we're mentally prepared for this, and that we're not going to panic because we know that, calm and certainty does not last forever. So yeah, I don't know what's next, but yeah, the signals that tell us that the economy is either accelerating or decelerating, and two, is there going to be some big exogenous effect that moves the economy for the next couple of quarters or months?
So leading economic indicators have been weak, I think, for a while. So so that maybe hasn't been a reliable way of assessing this, which I think you've written about. So what are a couple things you'll be looking at to kind of get a sense of the direction of the economy?
I think the unemployment rate is a great one. I know many people will tell you that the unemployment rate and job creation is kind of a lagging indicator, but it is moving, unfavorably. Now, I do know that a lot of it has to do with people entering the labor force, and when you go from not looking to a job to suddenly looking for a job but not having a job, that'll inflate these unemployment figures. But I do think it is a concern, job creation is slowing. Like I think I've been writing for maybe even a little over a year that job creation has been decelerating. And that has lined up with these announcements from, corporate America saying that, their sales growth is slowing. So I would keep an eye on that because, especially in the US where, personal consumption expenditures account for 2/3 of GDP, it really matters, how healthy and how strong, and if the consumer is getting stronger, if the consumer is getting weaker. And the biggest driver of that is job creation. So yeah, I would say keep an eye on the unemployment rate, keep an eye on job creation, and I think the highest frequency real-time indicator we have is weekly initial jobless claims that come out on Thursday mornings. It's not the most perfect indicator because this is actually people filing for unemployment insurance, and there have been reported issues of the numbers being affected by the Department of Labor's ability to process these
Oh, geez.
applications. So,
Yeah.
it's not the cleanest number, but over time, the moving averages seem to tell us something about what is going on in the economy. And those numbers have kind of ticked up a little bit. It's noisy, but they're low historically, but they seem to be trending up a little bit. So yeah, keep an eye on jobless claims, keep an eye on the unemployment rate, keep an eye on non-farm payroll job growth.
So we've made it this far, and I'm proud of us. We're 2.5 months out from an election, and we haven't talked politics yet. But I'd be remiss if I didn't take the opportunity to
Sure.
kind of tap into your knowledge and wisdom. How do you counsel individual investors? And I know that's not your job, but when you're thinking about elections and portfolios, and it's one of the most frequently asked questions advisors get. What are we doing around election season? What do you tell people when they ask you that?
I think the most important thing to remember is this is not, binary outcomes. This is not, with presidential elections, it's not one president is good for stocks and the economy, and one president is bad for stocks and the economy. Now, there may be a case to be made that, one president and their policies might be more favorable for corporate America for the economy. But historically, it's just not been the case that one is bad and one is good. It's usually one is good, one is less good. One is great for certain industries, one is less great for certain industries. And so, on balance, I think this stuff tends to net out. When it comes to things like social policies, when it comes to things like how economic policies affect people at different, levels of the income and stuff like that. Yeah, elections matter hugely, but from an investor perspective, I think it's pretty treacherous to try to trade election outcomes because what happens is, kind of like what we were saying before about what changed during the August market sell-off? Well, not a whole lot. I think what happens after elections is there's going to be a lot of people who are unhappy with the president who gets elected. And you know what? They're going to go to work the next day and they're going to go to lunch with their friends the next day. They're going to go to happy hour on Thursday. They're going to pick up their kids from school and they're going to take their family to the movies. Life, usually goes on. No one has ever, I mean, maybe a few, but at the margin, but it's immaterial. But no one wakes up the day after election day and says, you know what? For the next 4 years, we're not spending, we're not shopping, we're not going to Disney World. No one says that. Maybe to a lesser degree, but maybe people on the other side to a higher degree. I mean, when I think one of the fun things to watch is, the University of Michigan has this monthly sentiment survey where they also break down sentiment based off of political parties. And what you see, depending on who's in the White House, is one party has very high sentiment, another party has low sentiment. When those presidents change, those sentiment figures change based off of those demographics. And on net, they basically sort of, even out. And so all I can say is, yeah, just remember that it's not that one president is good and one president is bad. It's that one president might be less good than the other. But historically, we've seen economic growth and stock market rallies for presidents of both parties. And this, goes back for 100 years. And the only time that hasn't been the case is usually due to some, mass exogenous effect that no president has control over. Or, there's some big economic or financial crisis that, isn't the result of the current administration's policies, but decades of policies. So that's all I would say with that is don't try to trade the election. Focus more on stuff like labor market metrics and consumer finances, because as long as people are going out and spending, that has much more of an impact than, unfortunately, how people feel about who's in office.
Thank you, Sam. I really appreciate that. I always learn a lot when I talk to you, when I read your stuff. And so I appreciate your generosity with our listeners today. Remind everyone, how can they find your content? How can they follow you online?
Yep, the easiest way is to go to tker.co. That's tker.co. There's a free subscription and a paid subscription, but if any of your listeners are interested in what the paid content looks like, they can sign up for that free subscription, send a reply to that email and say, hey, I'm interested. I listened to you on Sammy's podcast, and I'm happy to throw a couple of free months so that people can see what it's all about.
That's great. I would definitely encourage them to do that. I love the way that you approach markets and investing, and thank you very much for your time, my friend.
Thanks for having me.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.